We're here at the Future Wealth Forum in Brisbane, and I'm joined by Jordan Eliseo, the Chief Economist of ABC Bullion in Sydney. Jordan, you've just come hot off the stage where you talked about how not to lose your money. Just give us the highlights of what that talk was about.
Yeah, look, basically the key point, I guess, for investors was that there's a lot of risk out there in the market right now. So the one thing you don't want to do is concentrate too much capital in any one particular asset class, be that shares, property, gold, cash, term deposits, you name it. So it was about basically highlighting to people the benefit of really spreading their money around in this environment.
So Jordan, this particular edition of the magazine, you had an article you did for us called The Permanent Portfolio, which lends nicely to your particular talk today. Just explain in your own words, or explain again I should say, what the Permanent Portfolio is for our listeners.
Yeah, and look, that was one of the subjects I actually did speak about. So basically, the permanent portfolio is an investment portfolio constructed of four primary asset classes, being gold, shares, bonds and cash. And basically the point of it is that if you keep 25% of your money in each of those four asset classes, over the long run, or the short, medium and long term, you should be able to compound your wealth at around 8 to 9% per annum without ever having any major years where you lose a lot of your capital. So it's not very volatile, it doesn't lose large amounts at any one time, and it's a really good way of building wealth over the long run. So I think it's really a good way of looking at markets, particularly now.
So how does that compare with a single asset? If you were just investing in, say, property or shares, how does that compare in the long run?
Yeah, look, obviously, if you concentrate all your capital in one particular area, then you may well obviously magnify the returns that you can generate. But if you get that wrong, it can absolutely destroy your portfolio, and more than your portfolio, it can cause large problems in your life if you lose a lot of your investment capital. So I think for most people don't want to risk it all on the one great trade. So having proper diversity in their portfolio is a much smarter way of going about things.
Yeah, okay. So it's a much sort of, I guess, safer, almost no frills approach to investing. You just keep it simple.
Yeah, absolutely. And look, maybe that's one of the reasons why it doesn't gain so much traction in broader portfolio management or amongst financial advisors, because it's not quite a do-nothing approach, but it's not a particularly difficult strategy to implement, so it's very difficult to charge high fees doing so. But individual investors could do that pretty much themselves with a minimum of fuss.
Is it one of those things that you have to reevaluate? How often should you reevaluate? Is it a 3-month or is it 12 months? Do you balance it back over to that sort of 25%?
Yeah, look, I think it depends on your own sort of personal preference. So some people, they might say, okay, I'm starting with 25% in each and I'm going to rebalance once a year, or I'm going to rebalance if one particular asset goes above 35% or below 15%. There's no right or wrong answer to that. That's obviously for each individual to choose. But the most important thing is to have that as your benchmark for how your asset should be constructed.
Yeah, okay, very good. And how much of that is in gold? I'm guessing 25%. Is there ever a point when you would recommend to go over something like 20, 25% in, say, precious metals?
Yeah, look, I guess in the interest of full disclosure, my portfolio has definitely more than 25% of it in physical gold and physical silver and even some gold mining companies right now. So I am definitely overweight precious metals right now, and that's appropriate for me. I've got a sort of 30+ year time frame with my SMSF, so volatility is not such a problem for me. But for everyday investors, again, I think the balance of that this portfolio and this strategy brings is probably the smartest way of going about things.
Oh, very good. And whereabouts, I think in the next sort of 6 or 12 months then, if that's the case, where in the next 6 or 12 months do you think precious metals, gold, silver are going to be heading?
Yeah, look, my view is that we're in the last 3 to 4 weeks we've seen the gold and silver market really narrow and trade in very tight ranges. My view is that by June, at the very latest, we'll have seen a breakout one way or the other. There is a chance in the short term that gold may need to go and retest around the US $1,200 an ounce point. So if I was new to this sector, I'd probably be averaging in my purchases right now. But I do believe that with a sort of 12-month and particularly 3 and 5 year view, gold prices will be significantly higher and silver will outperform in percentage terms.
Okay, so I guess as a new investor, it's probably important for them to come in at different multiple points. Is there a particular type of investment that works best for new investors? Is it something like bars, coins? What do you think works best?
Yeah, look, again, it really does come down to individuals' preference. The beauty of gold and silver is that, gold is gold and silver is silver. So for me personally, I just tend to buy cast bars because they have the lowest premium over and above the spot price. Some people like minted bars. Some people like buying silver coins, for example, or gold coins. You tend to pay a higher premium to buy those products. If people like that, then there's nothing wrong with doing that. But for an investor trying to get maximum bang for your buck, the smartest thing to do is to buy cast bars, in my opinion.
So Jordan, one of the biggest questions we get asked at Bullion and just here at the expo, people passing by, is about self-managed super funds. It's a big, I think, a myth that you can't buy gold and silver in self-managed super funds. Just elaborate on that and explain what is actually possible.
Yeah, that's right. So look, obviously superannuation in general is the largest financial asset that most Australians are going to build these days. Obviously, everyone's forced to put in, I think it's now 9.5% of their money into super. People our age are going to contribute hundreds of thousands across their working life. If you have a self-managed super fund, you actually can buy physical gold and silver as one of the assets in your portfolio. If you don't have a self-managed super fund, it is still possible to have gold in your portfolio. To me, it's a great shame that the large super funds in Australia have never had any major exposure to gold bullion. So it's one of those things that I think investors should look at, engage with their super and look at a way of putting an allocation to gold. It's the ultimate long-term savings asset. Superannuation's a long-term savings vehicle, so it makes sense to bring the two together.
Are you an advocate that everybody should have a portion of gold and silver in their portfolio of some sort?
Look, I'm an advocate that everybody should be looking to incorporate gold and silver and into their portfolios as part of a truly diversified fund. Is gold and silver appropriate for everybody? Look, I can't say that. I don't know that it's the right answer for everybody. But as I say, the point that I would probably try to make to viewers and people that are watching this is that as a standard, a traditional super fund has no exposure to gold at all. It is possible to do it. The long run returns speak for themselves. So I would be wanting to take control of my super so that this is one of the assets I can put into my portfolio.
Fantastic. Now, in the next edition of the Bullion magazine, we've actually got another article from you which talks about the London fix. Do you want to just share with everybody just a quick little snippet on what that article, what they're going to look forward to?
Yeah, absolutely. So, look, the article specifically references both the gold and the silver fix, which are sort of fairly archaic ways of pricing precious metals. They date back, in the case of the silver fix, well over 100 years in London. And basically, in the good old days, and even up until now, two or three banks would get together on the phone once a day and basically set the price of precious metals. And look, it made sense many years ago, but I'm actually looking forward to the metals market moving into the 21st century with more regulated and transparent pricing, and the article talks about that.
Fantastic. So I guess the last question is, how can people follow you? If they want to follow Jordan or where you work, just explain to us where they can get in touch.
Yeah, so look, obviously I work for ABC Bullion. We're Australia's largest independent bullion dealer. So they can find us or find me at our website, www.abcbullion.com.au. We run a complimentary investor centre where we talk about what's going on in the gold and silver market, in the economy and with people's superannuation. So people are welcome to sign up to that. I also do a fair bit of stuff on Twitter, so people can find me at Jordan Eliseo. It's JordanEliseo.
Fantastic. Well, thanks for joining us here on Bullion, and I look forward to the future. Should be exciting.